So first question to kick it off, guys, what gives you confidence in your ARR growth guide of 8% next year? Your customers are getting these kinds of results. Why shouldn't you be growing faster than 8%?
Thank you, Matt. I'll take it. So as we heard from customers, many of them have started to introduce AI into the operations at a small scale, and are going to scale next year. So we have confidence that customers are on their journey to increase automation as they see greater capacity and amazing AI business outcomes. In addition, we've introduced many new bots this year, and these bots are being now evaluated by many of our customers. So we expect also to have customers that will be adding these new bots next year. So generally, we believe that the demand for CX automation is going to be better next year. It's also that more and more customers are getting more comfortable as they see the results that are being reported by their peers. So we are optimistic about CX automation spending. Now, to put that into the perspective of the guidance we gave for this year for 8% ARR growth, in fact, we actually don't need demand to accelerate to get to 8%. So let me try to kind of quantify the model. So this year, Q1, Q2, Q3, our booking growth was around 30%. And if we continue to grow at these levels next year, we're going to have ARR more than 10%. So we are assuming booking growth of about 15 to 20% to drive the 8% guidance that we gave for our subscription ARR for next year. And of course, if we do see that the demand is continuing to be strong and maybe accelerating, and this is our initial guidance, and there will be plenty of opportunities to update that guidance throughout the year.
Okay, thanks, Dan. Next question, and I appreciate everyone sending them in. I'm getting them as you send them. Please continue to do so. The next one, can you talk more about some specific bots that are the driving force behind faster ARR growth?
All right, so I think, JB, that one is for you.
It feels like mine. So you heard a lot of our customers speak. A lot of them talked about the Verint Copilot bots. So it shouldn't be much of a surprise that the Copilot bots are going to drive a significant amount of our ARR growth. From the adoption of AI. What do the Copilot bots do? They help the agent in real time when they're engaging with the customer. So what agents usually do manually, those Copilot bots are automating different pieces of that activity. So every single interaction with every single agent gets faster. It gives better customer experience. They're answering questions. I gave you an example prior. So that content search example is a great example of a Copilot. Instead of putting the customer on hold and then finding the right piece of content and maybe reading a policy document for 2 minutes, immediately the Copilot shows me that content, shows me that knowledge, so I can answer the customer question without putting them on hold and ruining the experience. So those micro workflows, each and every one of those Copilot bots built on the right model, whether that's the latest and greatest in agentic AI, whether that's the latest open source model from Llama, the right foundation model, et cetera. Each model is chosen specifically for the job, trained on the right data, and delivers the result in real time. So every single agent interaction is better. And why do I believe these are going to be one of the main drivers? Both a lot of great customer outcomes and success, but also, just the agent population is the largest population of CX employees. So we're delivering tremendous business outcomes to the largest population of agents. And as they increase consumption, they started small and start to increase consumption, that will drive additional ARR and revenue growth for Verint.
Okay, thank you, Jamie. Next question. Are expectations for the CX spending environment next year compared to this year? You talk about CX automation becoming an emerging category. How's it different in contact center infrastructure?
Okay, I'll take this one. So spending environment, what we've seen in the last few years, during COVID, we saw customers investing in going to the cloud. So this was mostly around contact center infrastructure. And then over the last year, we see that this investment is starting to slow down as there's really no catalyst. So customers still want to move to the cloud, but there was no catalyst to do that the same way it was in COVID. And we see a slowdown in spending in the CX market overall. However, when you look at CX automation, which is a category in the CX market. This category is focused on automation of workflows. So as we obviously spend all that first hour automating workflows has great economic benefits for customers, and it's a very compelling ROI, and they all want to do that. So the issue was, is it mature? Can they trust AI? Can they really get the AI business outcomes that they expect? And I think over the last couple of years, the customers were basically playing and trying to gain confidence. And what we see now is we launched the platform five quarters ago. Then we started to have customers getting results from the platform. And over the last 3 quarters, we have increasingly reported customers saying, this is working, this is creating the automation that we expect, and the automation is creating the capacity and the outcomes that we expect. So when you put all that into perspective of the timeline, we're very optimistic about the CX spending environment now and into the coming year around CX automation. And we believe that when customers have a budget that already is set aside for 26, and they need to prioritize how they're going to spend that budget, they will spend that budget on CX automation solutions that bring ROI before they'll spend it on infrastructure projects. So regardless of the overall spending environment in terms of IT budgets, we believe now it's a good time for customers to start to shift more of that budget to where they get very compelling ROI.
Got it. Thank you, Dan. Next one. Glad you're simplifying the business in reporting ARR. I'm less familiar with the cash generation and contribution margin you mentioned. Can you walk us through the calculation and how we think about it?
That's a good one. And Grant, it's yours.
Great. Thank you. So let me, before I walk you through the metric itself, give you a little context around the metric and how we came about. So we did, with the transition to our subscription business, we looked at what other companies were using to report on the growth and performance metrics of a recurring or subscription business. And just through that review process, we embraced an approach that PTC had taken toward providing a metric that really helps avoid the 606 related divergence between annual revenue and annual billings. And that's what cash generation does, which is the first metric that I talked about earlier today. So cash generation is really a proxy for just that, our annual billings of the total company. And to get to that metric, we use subscription ARR, which again is a view of the true growth of our subscription business and as a proxy for the annual billings of that subscription business. And as just a reminder, we had previously been providing SaaS ARR. So subscription ARR incorporates SaaS ARR, but also incorporates the other portions of our subscription business, like optional managed services and support, to give a complete view of the ARR of that subscription business. So, and again, the reason that SaaS or subscription ARR mimics or is a proxy for the annual billings, just as a reminder, we typically bill customers annually in advance for those recurring streams, regardless of what the term length is. And that's where the 606 variability comes in from a revenue standpoint versus what that annual billing segment is for that business. So that's subscription ARR. You then add to that the non-recurring pieces, and you can add the non-recurring revenue, because in perpetual and professional services, our revenue is aligned to the annual billings. So the sum of those two is the cash generation of our business. And then to get to the next metric that I highlighted, which is cash contribution, just need to back out the traditional non-GAAP COGS and OpEx, which we report in our, it's the same numbers that we report in our income statement. And that provides the cash contribution, or said differently, that's really a measure of what the cash producing power is we have from the operations of our business. So hopefully we're very pleased to be able to simplify now. We had a lot of metrics in the past trying to help people navigate and understand the true growth of that subscription business. And obviously SaaS subscription ARR does that.
That's great, Grant. So you explained SaaS ARR is just a component of the ARR that we're reporting now. I think that's clear. Can you also elaborate, and you did, but can you elaborate on why ARR is the proxy for cash generation?
Sure. So subscription ARR being the proxy for cash generation from that subscription business, again, we invoice customers annually in advance, regardless of whether it's a 1 year, 2 year, or 3 year term for those recurring contracts. So that's why the cash is very closely aligned to the SaaS ARR or subscription ARR from that business.
Be clear that so ARR is the run rate, and we take the quarter revenue times 4 plus booking. But because of the billing 1 year in advance, it is the right proxy for cash production.
Absolutely.
Okay, thank you. Next question. I'm going to combine a couple here. So what gives you confidence from a product perspective that your competitive advantage in contact center applications is sustainable, is in-house? Are customers who are potentially trying to build these kinds of solutions in-house, seen as competitive as well?
Okay, so let's break it into 2 pieces. And Jamie, if you can start with, what our customers are doing themselves, and then maybe we can go then to, what give us the confidence that we have the competitive differentiation.
Sure. So I talk to a lot of customers, obviously as part of my job, and I hear a tremendous amount of frustration from those customers around the internal science projects, around waiting for the results from their AI experiments. And I understand how they got into this situation in many ways. We've been, as an industry and as a market trying to automate customer experience workflows for a very long time. And quite honestly, early results were poor. They saw, automations that gave the wrong messages to customers and led to tremendous increases in risk. They saw, failed AI experiments that they sunk a year of development into for no legitimate business outcome. They saw, AI that gave the wrong predictions as often as it gave the right predictions. So in response to some of the early attempts at automation that really didn't deliver those types of outcomes, they decided to take a very cautious adoption approach this time, and to do a lot of experimentation. They worked with IT. IT, obviously, for all new technology, is going to be where they do the initial evaluations and try to build those skills and build their own AI capabilities. And what they found out is that's really hard, and it takes a really, really long time. So that paralysis and the paralysis and the caution is warranted. But where we've been able to break that logjam successfully is, one, we allow them to start small, prove value, increase consumption as they see outcomes. So it makes it easy for them to believe, because they see it in their own environment before they have to make a big purchase decision. And then 2, I'd say we can show them, like we showed you today, real experiences from their peers in their sector with those same CX workflows, where we've successfully delivered an automated solution that automates that same workflow, delivers an amazing business outcome. So it builds the pressure. They already have enough demand, but now they see it's possible. My competitors are doing it. I cannot wait any longer for these experiments to pan out. So I think for me, that's a lot of the perspective on internal projects. And yeah, I don't view them as competitive because I don't see them delivering a completeness of solution in the same outcome. But I do view them as causing delays and smaller or cautious adoption, I would say.
So that's good in terms of what IT is doing, and clearly in our platform we also are providing complete solutions, but we also provide tools for IT so they can take our tools and develop unique automation that maybe we don't support today. One of the clear competitive differentiation to the second part of the question is obviously how we build the platform with AI and data at the core, and it's the domain expertise that we have around CX workflows. And CX workflows are unique. They're not the same as other workflows. Enterprises have many, many different workflows. IT is trying to bring automation, bring GenAI to automate anything they can. But when it comes to CX workflows, we just have the expertise. We're doing it with a lot of precision because we chose a very differentiated approach to automation. We're not trying to throw GenAI to automate everything. We're trying to do micro workflows. Every step of the workflow that is right for automation, we create a bot specifically for that. We're using the relevant AI model, which could be very, very different models. Some are agentic AI, some are Gen AI, some are proprietary AI. But we're using the right model. We train the model on the right data because otherwise it's not creating the right precision in automation. And all that is done automatically in our platform. So the net result is a step that was done by a person is replaced by a Verint bot. And then we have so many bots automating different steps in the platform that together we are creating enormous AI business outcomes. That's a very differentiated approach. So I'll say here that not only we create outcomes today like no other vendor in the market, but it's a very sustainable advantage because it's fundamental to how we approach automation. And we didn't approach this as we want to be an AI company. Our approach was we want to be an AI business outcome company. We want to take all the domain expertise and the knowledge that we have learned because we've been actually building workflows for our customers for 20 years, right? We are the WFE leader. This was about building the workflows. Obviously, we have intimate workflows. And now we are not just the WFE leader, but also the CX automation category leader, taking that same workflows without disruption and helping customers get automation in a very, very tangible way. And you can see from all the examples we gave today, once they prove it to themselves, we don't have any objection. IT is not objecting. Plenty of stuff they can develop. So it's not that they want to develop, they just don't know that it can be done by a vendor. Once they see that we have the outcomes that we are delivering, IT is happy to go do something different. And obviously the business is very happy because they get the outcomes in terms of elevating CX and reducing operating costs, and that brings them compelling ROIs.
Okay. Thank you, guys. I'll move to the next one. Received a few questions on guidance. I'm going to paraphrase. You talked about another year bundled SaaS revenue growth next year. Can you basically discuss unbundled, your thoughts on unbundled next year?
What ARR capture everything, right? Bundle, unbundle, all the same way in a routable view. I do acknowledge that, Grant, if you can give more kind of color on what's going on within our unbundled stream.
Sure. So, and it's really the success of our hybrid cloud model that we saw this year, which again, we talked a lot about today, but that enables customers to get access to our AI-driven bots, which are only deployed in the Verint cloud while maintaining their on-prem footprint. And that success enabled us to realize strong growth this year in unbundled SaaS revenue. So next year, we expect most of our bookings are once again going to come from the AI adoption, which we'll recognize in bundled SaaS. However, because we have a number of hybrid customers and they have a large pool of renewals that come up and we expect to renew again next year, we do expect unbundled SaaS revenue to grow. The growth will moderate and should be single digits in fiscal 26.
Right, and I think, Grant, you showed an example of a healthcare insurance company, right? And they grew over 2 years ARR from 3 million to 14 million.
That's right.
And the vast majority of that growth was in bundle as they were adopting 18 different bots, but they also grew at the same time in unbundle a little bit, right? So that's what's giving you confidence on the single-digit growth next year. Obviously, not as much growth as we expect in bundle because AI is driving the bundle growth, but still some growth in unbundle as hybrid customers are expanding in unbundle as well.
On that topic, just a clarification question that came in, which I think is important for people to understand. Is bundled revenue 100% bot revenue?
So it's almost 100%. So what we do in our cloud, because bundled revenue is defined as revenue from deployment in the Verint cloud. So all these customers that have deployment in the Verint cloud, we continuously update software in the Verint cloud. And we have updated a lot of our products to include AI. So that means that when you buy a bot, when you buy a new functionality that is delivered by a bot, obviously that will be in the bundle SaaS revenue. But we also have now AI embedded in almost every application. So the reality is that bundle SaaS revenue is practically equal AI deployments.
Got it. Thank you, Dan. Next question. Hybrid cloud seems like a competitive advantage. How difficult is it for competitors to do this?
Jamie, that's I think we'll.
That's like me as well.
Right?
It's a great question. Thank you whoever gave that question because it's one of my favorite topics to talk about. But yes, it's absolutely one of our largest advantages in any competitive scenario. it's not something that happens overnight. We had to really have the foresight to build that into the platform at the core when we started building the platform. If you think about most of the alternatives out there, they don't support hybrid. They were born entirely in the cloud and wear that like a badge, which is fine, but it makes it very, very difficult then for them to support the complexity of the enterprise ecosystem. I mean, I talked to 1 million customers. I talked to lots and lots of enterprises, and none of them are 100% in the cloud. So it's our ability to meet them where they are in their ecosystem is a tremendous differentiator. And unless you build it from the ground up to support that, the technology is different, the way you integrate is different, the way you network is different. The skill sets you need to support that type of environment aren't really present in many, born in the cloud companies. So yes, it's a tremendous differentiator for us. And what it enables, just to be clear, I mean, I like talking about architecture a lot, obviously, but what it enables is that's why we can go and deliver those fast outcomes faster than any competitor, because we meet them how they're deployed. We don't introduce a bunch of technology and infrastructure work for them to be able to see those outcomes. We walk in, we connect to what they have from our cloud into their ecosystem in a hybrid capacity, and just focus on getting an outcome from AI, as opposed to years potentially of disruptive infrastructure work before they see the light at the end of the tunnel. So yeah, it's a huge differentiator for us, and more often than not, the reason many of my customers choose to partner with us, because we can just do it faster, better, and deliver it quicker than anyone else out there.
Thank you, Jamie.
I'd like to add 1 second, Matt. Let's remind, so hybrid cloud is hard to build, but let's remind ourselves, why is it so compelling for customers? The alternative to hybrid cloud is you have to modernize and move your entire infrastructure to the cloud. And that, for enterprise companies, that could be a 2 years project, very disruptive. And at the end of that project, you may or may not get the AI business outcomes that you expect. So not only it's going to take you 2 years and it's going to be expensive and disruptive, but also it doesn't give you the ability to test on a gradual manner, what is really the value you're getting. So by separating that in a hybrid cloud and say, keep what you have in whatever existing infrastructure, the way you run it. Let's add AI in the cloud to your existing infrastructure in any pace that you like. Every step you measure the outcomes, you prove the outcome in your environment, and then you decide to grow. That's really why it's so compelling to customers. So it's avoiding risk, and it's getting the benefits now. You get ROI now for 2 years that otherwise you wouldn't get, but you also get ROI that you really see it's working, as opposed to a promise for an ROI at the end of the 2 years, which many of our customers are skeptical about whether that's going to happen. So it's a technology differentiation, right, of building a platform that is hybrid from the core, but it has a very compelling economic benefit that drives customer behavior towards hybrid.
Understood. Thank you, guys. So the next question effectively is, the stock doesn't reflect the value we're hearing about today. Why do you feel like it trades like it does? That's essentially what, to paraphrase.
Alan, can you take this one?
Sure. So I think the way we think about it is that if you look at the CX space overall, stocks generally aren't trading very well. They're under pressure. And our view is that the market's just not today distinguishing between companies that are focused on infrastructure and companies that are going after the CX automation opportunity like we are. For all the reasons we discussed today, we believe we're very well positioned to go after this emerging category. And over time, that should accelerate our growth. But it's just not reflected in our stock price today. Today, we're traded more like an infrastructure company than an AI company. We're not getting credit for the opportunity. We're not getting credit for our leadership. And it's primarily because it's an early stage market, and we haven't shown the full acceleration in our results yet. So I think what hopefully will change that is that over time, as AI adoption drives faster AR growth, investors will be able to see how this is translating to our business better. And I'm hoping that, by reporting AR and also cash flow metrics going forward, investors will have better visibility into our progress towards capitalizing on this opportunity.
Thank you. Next question is essentially, came in multiple ways. Discuss the long-term outlook of the business. How are you thinking about things? How should we think about things? Kind of an open-ended question, but I think it's important to.
I got it. Let me take it. So today we provided fiscal 26 guidance for ARR. And we talked about we'll provide the revenue and EPS guidance in our Q4 conference call. The ARR obviously is what's driving the growth of the overall business because the rest of the business is perpetual and professional services, which will remain flat. And that's pretty much a view long term. We don't see perpetual services as the growth driver. So from an ARR perspective, we talked about ARR is 8% for guidance. I did mention before that that's predicated on a certain booking level, and if we achieve higher booking level, the same we're achieving this year, then this will drive ARR growth to be 10%. So our perspective on long-term growth really did not change. ARR and cash generation and cash contribution, these are metrics that helps investors to simplify the way to measure the business. They don't change the growth rate of the business, but they will simplify because they basically neutralize the variability that comes with the 606 accounting. But in terms of the true growth of the business, we're committed to the operating leverage that we have in the business. So we'll continue to expand margins next year and the year after. And we are planning to continue to accelerate double-digit ARR growth. And all that will drive revenue and EPS and the Rule of 40 target that we've discussed before.
Okay. Thanks, Dan. A question related to that. Can you discuss your thoughts on the macro environment as we sit here? 10,000 customers globally, would be interested in your perspective.
So the macro is starting with, what are the challenges that the CX market has been facing? And that challenge actually did not change, right? We talked about $2 trillion of labor spend. And if you want to elevate CX, you have only one choice, hire more people, and that's not sustainable. It's not a new challenge. It's a challenge that customers have been fighting for many years. And to a large extent, in WFE, which we are a category leader, we've been providing customers productivity tools. Workforce engagement is basically creating workflows to improve capacity and productivity. So this is not a different experience for Verint. It's not a new challenge for the market. So what has changed? What has changed is that the technology has changed. And now with the emergence of more and more powerful AI models, and a platform like Verint, CX automation platform that take models and quickly train them and keep training them so they don't degrade. So there's continuous training on the relevant data and then embedding them into the workflows. That creates now the opportunity to automate automation like didn't exist before. So that's why we refer to this as an emergence of the category, or we refer to this as the first innings of the CX automation category. And we're very, very, very pleased to be the leaders to step the way and lead the market into demonstrating what actually can be done. So based on the success so far, we believe that the market will accelerate and increase automation. CX automation is complex. It's because it's a real-time environment. The workflows are not straightforward. These are not just cut and paste workflow. Much more complex workflows that requires multimedia, multimodalities. Agents are working on different channels. Customers are calling from different places. Topics change very, very quickly as customers have new questions about new policies, new products, and so on. So CX is a complex environment, but what Verint is telling the market today, it can be automated. Now, you can't throw GenAI and hope that everything will be automated. That doesn't work. That was proven not to work. But if you adopt an approach of taking one micro workflow at a time and automating that micro workflow with precision, that works. So all that, how it's related to the macro. Customers would love to spend money when they are convinced that they get 20x ROI. And we talked about customers getting 20x ROI with CX automation. So I think we are at the stage where the market just needs to be more confident that this can work. And not only that it can work, but it can work for me. Customers want to see that it works in their own environment. Obviously, when we have peers reporting, so when healthcare companies hear from another healthcare company about their success, that gives them more confidence. And even more so, if they can taste it in their own environment, if they can start small and prove it to themselves, that gives them the utmost confidence that it works. So I think that the spending for CX automation will increase. I think it will shift from other IT budget into more and more CX automation. And I think we are in a very exciting area in the market that is about to change not just the way customers are going to deliver ROI, but I think they will be able to deliver better customer experience and then create better customer relationships. And that's going to make our customers more differentiated. I believe that brands that are not going to adopt CX automation and continue to deliver an okay customer experience will just be left behind. So this is not just technology and automation that drive costs down. This is giving our customers an opportunity to actually use that technology to create customer loyalty and retention and maximize customer revenue over time. And I will end this by actually pointing out many of the customers that you heard from today actually said just that they're not reducing headcount yet, although they see extra capacity. Again, Volaris, the airline in Mexico, said, hey, we have the same number of agents, but they are handling 3x times the traffic. So we did not have to increase the number of agents, but we were able to give customers much faster responses, and they're calling more, and we're creating revenue, we're increasing revenue. So we're increasing the CSAT score and we're increasing revenue. So many of the customers today spoke about how they're using the capacity first to increase revenue and customer satisfaction. But clearly, as they buy more and more of the Verint bots and they increase the capacity more and more, there will be a time where they have enough capacity to elevate the customer experience and extra capacity also to reduce the cost overall in their customer operations.
Yeah. Okay. Thanks, Dan. In terms of the agent, seat counts and all that, we got a few of those questions. I'm glad you touched on it because I was going to hit on that coming up. I do want to go on cap structure, if we can. A few questions coming in on that. We mentioned debt coming up in 2026. If we can just expand on those securities, our thoughts and plans here in early 2025.
Grant, will you take it?
Sure, happy to. So, I mentioned in our prepared remarks, we do have some debt coming up in calendar 26 is when it comes due. So it comes current a little bit later this year, and we'll be proactive about managing our balance sheet with that debt in mind. Just as a reminder, we do have strong cash flow and the generation that I talked about. So we have broad optionality, access to multiple markets, and we'll be very proactive in managing that. With regard to the capital allocation thought, right, with the use of the strong cash flow that we have coming in, we obviously expect the biggest use of our free cash flow to be on buybacks. And we've been steadily buying back shares over the last couple of years, and we started a new $200 million buyback program, which that was just in September. So that ought to be the largest use of our free cash flow. But in addition to buybacks, we may allocate some of that for debt repayment and some of it for the tech tuck-ins that we talked about as well. So I guess if I share anything, the idea will be very proactive. We do have some of the debt. We have time, to finalize our decisions on what we do moving forward, and we'll certainly be sharing that with you during our Q4 earnings at that point. Thank you, Grant.
Got a question here for Daniel. You'll dole it out, but I think I know what it's coming to. Do you allow customers to make customizations on their specific workflows? How does this affect the cost structure on both sides?
Jamie?
Yeah, I already went off mute. I don't like the term customization because it suggests like professional services and rebuilding and doing a lot of stuff like that. I'll go with configuration and tuning. But yeah, I mean, as Dan mentioned, these CX workflows are sophisticated, they're messy, there's multiple channels, there's multiple back-end systems. We build experiences and customer experience that automates significant portions of those workflows. So we have to talk to a variety of systems in their organizations, even ones that are unique and proprietary to them. So there's always some level of how do we fit it into your workflow. But we provide, the automated tuning that happens inside the platform. So like, you don't have to tell us about all the new products or new words that emerge in your language. We discover that as part of our DaVinci infrastructure. We have low code tools. So when you need to call out to a system that you have internally, it's very easy, a few button clicks, and lets you configure those. So generally, we allow our customers to configure it and tune it for their environment, or the platform does a tremendous amount of the tuning on their behalf. And if customers want us to do it, we can also deliver to that as well. But the tools are already made in the platform for customers to be self-sufficient in configuring it in their environment and connecting it to the variety of systems and other necessary pieces to fulfill the entirety of the workflow.
Thanks, Jamie. Another question. The essence of the questions that have come in around this are about agent licenses in our base, which we talked about 4 million before. What are the implications and potential of that happening, and whether it's related to AI or otherwise?
Okay, so the question is related to reduction
Correct.
In our agent customer base. Okay. So 4 million agents today that we power with workflows, with workforce engagement solutions. We generate on average $200 per agent per year. So that's what we are about to lose when the customer is deciding to reduce the number of agents. So it's $200 per agent per year. And we are basically, with our bot program, we're already encouraging customers to do just that, to move from agent licenses to AI licenses. And the way we do that is we provide them credits. So if a customer decides that they don't need any more agent licenses during the term of the contract, they will get credit, and they can apply that credit to buy the AI licenses that they need, which is really what they need in order to create a capacity that eventually will cause that agent count to come down. We also provided the examples earlier about the magnitude here. So when we face this with customers that they want to do this trade, we on average get a 10x growth opportunity, because for the $200 of license for agent license per year, we will be receiving $2,000 of bot licenses that create that capacity. Now, again, to remind you, while the customer is paying us 10x more, 2,000 instead of 200, they're saving $40,000 because that's the cost of the agent. So it's a 20x ROI for the customer. It's a win-win opportunity. Now, I would say that we reported 4 million agents last year in Investor Day, and we're reporting 4 million agents this year. So we haven't seen degradation in the overall number of agents. We do see customers that are actually reducing agents. We do have those, but we also see many, as again we showed you earlier today, that are saying we have great capacity that we are producing, but we want to use the capacity for all kinds of things before we actually want to use it for replacing agents. So with that, we talked about, for fiscal 26, when we look at the ARR guidance we provided, we think that we're going to see a lot of capacity created, but still not that much degradation in agent counts. But in subsequent years, we're going to start to see more and more of that degradation as they buy more and more AI and continue to increase the capacity. And of course, in that point in time, we'll be happy to do this exchange program for our customers and get the 10x ROI opportunity. So right now, we are in the early stage. They're buying bots. They're creating capacity. They're buying many, many different bots, which is good. They're not necessarily scaling up those bots to full capacity immediately. Each bot is scaled to a separate time. But the fact that many of our customers are experimenting with automating very, very different workflows with different bots is part of how they think about proving it and then scaling, proving it and scaling. And again, at some point, they will scale to a point that they will see the headcount reduction, and we will see the 10x ROI kicking in. Probably not in 26 in a material way, but more likely in 27, which will drive more growth for Verint.
Okay. Well, thank you, everyone. That's going to wrap it up. I hope I paraphrased most, if not all, the questions. For any specific question that we did not get to,